Hi, greetings. Welcome back to the continuing lecture in business math. And today's topic is inventory valuation. So, in our last class, we talked about inventory estimation, and today it is inventory valuation. So, what's the difference between inventory valuation and inventory estimation? Well, as I said before, in our previous classes, right? Inventory estimation is to literally estimate or get a rough estimation of the CGS, cost of goods, and also you can also uh, through that you can also get a rough estimation of ending inventory or net purchase or whatever. You can get estimation of any element, right, in the CGS section of the income statement, right? But the next question is, who uses, inventory estimation? Well, any party who wants to get an assessment of or estimation of what would be the true cost, and I suggested IRS as one because this could be a rough. I mean, they can have more sophisticated technique to actually estimate the CGS of any company, but then the purpose, if you think about it, the purpose, why would IRS want to do that? Well, because they have an incentive to know the true cost, because by estimating what the true cost might be, then that gives them an idea of whether the EBIT is correct, legitimate, and correct, and accurate and correct, right? And depending on that, then EBT would be legit and correct, and then the taxes paid, right? Tax amount would be correctly calculated. But as I said, most companies have a lot of incentives to minimize their taxes, right? So there could be a overstatement of cost, because if cost is overstated, CGS is overstated, then EBIT will be mitigated, and if EBIT is mitigated, then EBT will be mitigated. So then tax will be mitigated, right? The same tax rate applied to the mitigated EBT would result in smaller tax amount. So as I said, they have all the businesses have incentives to even cross the line. I mean, if they whole all due the reality of the world is that until they get caught, they are innocent, right? They all pretend to be they are all pretending to be legit, right? Legitimate, and until they get caught, right? Bernie Madoff. Who's Bernie Madoff? Some of you may remember the name. Bernie Madoff was uh, a Wall Street fund manager, and he had a reputation as a good fund manager. But the thing is, what he was doing was, Ponzi scheme, right? Ponzi scheme is what, you're not really making any profit, but you just um, you just pay the old investors. For example, when the a fund manager is basically taking in deposits, taking in investment from their clients, and uh, build their funds. The more clients, the bigger the size of the fund, and they have bigger investment in the market. Now, usually, the fund managers should be, uh, they must make it transparent, right? They must make, all their operations, transparent. But some fund managers, especially private equity, and there are some, esoteric, uh, very secretive, funds, uh, hedge funds, for one example. Their investors is totally based on, the clients are entrusting their money with them, and, based on, past track record and reputation. Some fund managers pass for pass pass by as, a very prestigious boutique fund, right? So like, um, then they are very secretive. They don't even, expose disclose, their balance sheet, income statement, and things like that. But the clients get their promised return. As long as they get their promised return, uh, they don't care. They're happy with it. But then this led to a series of Ponzi scheme. What Bernie Madoff did was, let's say his fund he was managing was, $10 billion. Well, $10 billion is, obviously uh, the client's money, right? So he basically, says to his clients, so just entrust the money with me. Don't ask any questions. I will guarantee 15% return or 20% return. And as long as you get 20% return, don't question anything. Just leave it to me. And there are lots of, private equity funds, that operate that way. And the clients, are basically within through the connections, so it's uh, basically a very closed circle. Uh, and then with the reputation, I mean, Bernie Madoff has lived up to his, promises. So he has a reputation, positive reputation. Uh, so the clients don't question anything. But as long as they get like 20% a year, they are happy. So then the problem is no fund manager can persistently earn 20%. I mean, of course, to pay out 20% to the investors, they actually the return to the fund should be greater than 20%, maybe 2%, 23% anyway, and the fund manager must get his cut. Of course, his fees are coming off the clients cash flow, or clients return to clients. But anyway, the idea is, um, if you um, if you are managing a like $10 billion funds, for over 20 years, I mean, some years you may have really lived up to your uh, promises. Some years you can't. How can you consistently produce, 20% return? So that's not, and even, consistently every year without any gap, right? Uh, without exception, every year after year. So this turns out to be some fishy business. Why? Some years you lose, some years you gain, some years you have positive return, but you cannot, but not 20%. Some years you have negative returns, but you have to still deliver your guarantee. So what happens? If in the years you make loss, uh, all you need to do is simply, get new investors and have new investors put, at least, 2 billion. 2 billion is 20% of 10 billion. So with this 2 billion, you pay off the old clients who are expecting 20% return, right? And then this is what you keep doing this year after year. In other words, it's like paying your credit card with another credit card, right? This is called Ponzi scheme, Ponzi financing, or Ponzi scheme. It's like pyramid scheme. You are not really making any profit, but you just make profit by adding on new members, right? Who pay into this pyramid scheme, right? So it's a scam. Ponzi financing is a scam, right? Your fund is not really making any money, but you are just, paying out to the old clients with, investment from new clients, and rolling over this way for many years. So in early 2000, this was like in early 2000s, Barney Madoff was, caught. So he's still in jail. He went to jail, still in jail, So, but then think about it. Most fund there's a saying in the Wall Street that the most fund managers, portfolio managers, are like Bernie Madoff, right? Everything is Ponzi scheme until they get caught, right? Until caught, right? They are just, a great, legitimate business, right? Legitimate. So that's the reason I'm saying this is a lot of businesses have huge incentive to cheat on taxes, right? And until they get caught, it's all legit, right? But anyway, the idea is, so that's why IRS has an incentive to use even the rough measure, like, inventory estimation, to run a quick scan, because you cannot run hundreds of thousands of, or even millions of businesses in the US. IRS cannot do the thorough scan, complete scan of all those businesses. They will have to run a very quick scan, and the quick scan can be done with a rough measure like that, inventory estimation, and then anything gets checked through the quick scan, then they can focus more efforts on that particular business, and then once they gain sufficient grounds for suspicion, then they will audit, right, that company. So anyway, that is inventory estimation. But then what is inventory valuation? Inventory valuation is actually really putting a correct dollar value on the ending inventory. you might wonder, isn't it easily done when you do, inventory estimation? I mean, but once again, inventory estimation is just a rough measure, estimation, right? Estimation is like, approximation, right? Valuation is more, precise, and valuation is more rational. So then think about it. Inventory is basically in the CGS section of the income statement. So inventory, and then you have, CGS section consists of basically beginning inventory, net purchase, ending inventory, CGS, right? But you saw before, that's how the income statement is constructed, right? That's the structure of income statement. But you remember, uh, although that is the structure, right, of the CGS section, but then I told you it's not exactly in the chronological order. Why? Because, of course, at the beginning, there's beginning inventory, right? And then there is net purchase, right? And then there will be what. So when you have beginning inventory and net purchase, that's called the GAS, right? Goods available for sale. That's what you have to sell for that month or for that quarter. Now then, what should happen next? What should happen next is sale, right? But the sale is not um, expressed in cost. Sale is expressed in price, right? Revenue is expressed in price. So the cost side of the sale is called, CGS, right? So and then so CGS must be recorded, and if you subtract CGS from the GAS, then that's the ending inventory, and that is the chronological order. But as I said, so actually in income statement, that CGS and ending inventory is switched. Their places are switched. That's why I'm saying it's not exactly in the chronological order what's in the income statement. But then now let's think about it. Uh, so a new purchase or net purchase, actually, I call it net purchase, but I just put it as new purchase here. Uh, the problem happens, um, uh, I mean, why ending inventory needs to be more precisely uh, accounted for is because the net purchase doesn't happen just one uh, at one point, right? It just doesn't happen just at once. Net purchase can happen multiple times, right, at different points during the operating period. And then the purchase price of the items would be all different depending on at what point you are, right? So, and then the next question is, let me see, here's an example, right? First, suppose, I don't know what this may be. Let's say is a tennis ball. We're talking about a tennis ball, and this uh, business, this store is a sporting goods store, and in the sporting goods store, you have tennis balls, right? And when you buy, suppose first quarter, January, February, March, during the first quarter, the net purchase was made at three different points, right? Uh, so in January, you made 5,400 400 units of tennis balls, right? February 8,450, March 12,370 tennis balls, and these tennis balls were purchased at different points in time, so the prices are different. Why? Of course, price changes, even constantly, right? Because there's a it's determined by the demand and supply, and demand and supply changes also constantly. And also, think about it. There's a seasonality in the demand for tennis balls. Isn't that right? Why? Why? Tennis, you don't play tennis when it is very cold because tennis is it's an outdoor sports, right? Of course, you can play squash indoors, racquetball indoors, but tennis is an outdoor sports, right? You play tennis in the year. So January, how many people play tennis outdoors? You know, clearly, but as the weather warms, right, more and more people will play tennis outdoors, right, outside. So when it's very cold, due to low demand, the price of the tennis balls per unit, right, can be the lowest of all 3 months, right? And then as the weather warms up, it will go up a little, right? Gradually, right? So the demand also reflects that. Quantity demanded also reflects that, right? So our question, and then at the end of the first quarter, there will be something left in the ending inventory, right? So the net purchase during the 3 months was 26,250 units, right? Tennis balls, right? 26,250 tennis balls. And you made a sale during the first quarter. And at the end of the quarter, you have 4,572 units left, tennis balls left, right? That's called ending inventory. But now here we are facing a problem here. So what dollar value do we put on this ending inventory, right? That would be a big question, isn't it right? Don't you think? Why? Because whatever is left in this ending inventory, I mean, if all of them came from January purchase, right? If all of them came from January purchase, we can value them. We can value them at 68 cents per unit. Or if they all came from the February purchase, then we can just multiply it by 70 cents, right? Or still, if it all came from March, we can simply multiply them by March price. But then we don't know. I mean, some of this 4,500 units, 72 units, some of them could have come from January purchase. Some of that may be from February purchase, or some of it may be from March purchase, right? We cannot trace them unless we can trace them all the way back to when they were purchased, right? We will have to use some we'll have to have a technique or some average value, right, to multiply to that quantity in the ending inventory. Now our next question is then, of course, these days, can we not trace it back to when they were? Yes, these days we have everything is scanned. There's barcode on everything, so you scan. But of course, barcode is on the case. I mean, if tennis balls they come in the case of cylinder case, and there are like 5 tennis balls. But if they are still in the cylinder case, and there would be a label with the barcode, and you can scan it and trace it back to when they were purchased, right? But if they are not in the barcode, individual tennis balls don't have barcode on them, right? And what if, I mean, we take it for granted, barcode is taken for granted these days, but barcode isn't, that wasn't invented that long ago. I mean, 1980s. I mean, the barcode was probably used, in some around in 1970s. It started to get used, prior to 1970s. How would you track the inventory without the barcode? There was no way to track the inventory to its purchase point. So when you are doing when in those days when they say I'm doing the inventory, what does that mean? You really have to go to the storage room uh, and count all the merchandise, the inventory in the merchandise in the inventory, right? And if there are like 5,000 tennis balls left, then you have to put the value, dollar value on it, and there had to be some rational and reasonable technique you can use to put dollar value on it. So there are three techniques, right? Three techniques. One is called weighted average cost. Second one is FIFO. Third one, LIFO. FIFO stands for first in, first out. LIFO stands for last in, first out. But the weighted average is quite obvious, right? You know what weighted average is. With there are simple average and weighted average and geometric average. Weighted average is you cannot use simple average. Um, Simple average is something like this. So unit price of these January purchase, unit prices are like 68 cents, 70 cents, 72 cents. You think, oh, if I take the average of these, then that's the so to take the average, what do? You add them up and divide it by 3, right? What is that? That's called simple average, right? You can't use it in this situation. Why? You use the simple average when they are all in equal proportion, right? But when they are all in different proportion, right? The weights are different. Look, the quantity January purchase is 5,000, February purchase 8,000, March purchase 12,000. Look, they are all in different quantity, right? Different proportions, right? So clearly, their weights are different. You cannot simply add them up and divide it by 3, right? Uh, so what? It's like your GPA. Your GPA is not a simple average, but weighted average. Why? Um, B in English is not the same thing as B in math. Why? Math is 4 credit. Uh, English is 3 credit, right? Um, A in music, let's say music 101, and let's say this is a 2 credit course. If it is a 2 credit course, A in 2 credit course doesn't weigh as much as A minus or B plus in 4 credit course, because 4 credit courses weighs twice as much as 2 credit course, right? Makes sense? So what do you need to do then? You must weight each of these prices by their proportion. So this times this, and this is the weighted result, the product of these two columns, right? And this times this, that's the weighted value, right? This times this. And so then you take the sum of all these weighted values, right? The products, and then this is the sum of all of them. And you take the sum of these, and you divide this by this, and that's the weighted average, right? Divide this by this. So I'm going to get to that in Excel. But basically, let me stop sharing this and go to Excel. So let's see, where do I have this file? Okay. So here it is. I wonder if you can see this, but let me put. Yeah, let me share this. Okay. Now you see this now? Do you see the Excel file? Okay. Let me load up a little so it's more visible to you. So let's take a look at this example. So let me first delete. Let me clear out all these. And let me put, yellow highlight there, and then, okay, actually this should be the yellow highlight. Everything else should be like olive green. Alrighty. So let's do the first example. So January you purchased 10,000 units, February 8,000, March 10,000, right? Let's make this more interesting. What was our 5,000? Okay. 5430, just like our example in the slide. 8,050, 12,370. Okay. Now, let me also then what do I do? First, it's not that difficult. Simply this time, this, and you drag it down, right? And then you find, auto sum. Oh, I should have done simply auto sum there. Auto sum, right? And then if you divide this by this, then that's the weighted average, right? And you might say, oh, because it's 68 cents, if I take, isn't that the average of these I've been saying, when you say average, you mean mostly a simple average, right, or arithmetic average. But again, you cannot use it here. And let me simply take the average, right, of, let's take simple average, right, which is, I can use the average command. Or, I will do it like See, it's clearly different. Simple average and weighted average are clearly different, right? If you suppose I do, we take sum of these three and divide it by 3, right? That's the simple average, right? That's what you understand as average, but you cannot use simple average here, right? That's the reason. Now, so then let's do the second example. So here, okay, I'm gonna delete all of these and so the point is, so if we use weighted average, right? I will call it the cost method, right? So let's delete cost. Now, if the ending inventory is 4,500, what we should put there as the, oh, of course, I'm going to put, if you use weighted average, right? This will be multiplied by S. Okay, there you go. Now, FIFO and LIFO. What's FIFO and LIFO? FIFO is first in, first out inventory valuation technique. And in FIFO, you assume whatever came in first is sold out first, right? Whatever came in first is sold first. I mean, that's quite more, intuitive and natural assumption. Why, if the merchandise, the inventory came in January, the merchandise got sold either already in January or in February at latest, right? So you got, net purchase, another, purchase in February. So most likely they got sold in February and at latest by March. And whatever was purchased in March partially got sold. But, if there is anything left, that must be more likely to be coming from the late purchase. Make sense? So that's what FIFO assumption is all about. So that means whatever is left in the ending inventory must have come from March, right? Makes sense? March inventory. And this assumption is more, natural, right? But some people get it. Some people get it wrong. They say, "Oh, it's first in, first out." So, first out. Oh, then here from here, first out. No, no. Out means they got sold, right? Out means they got sold. If they got sold, then can they still remain in the ending inventory? Huh? Make sense? Ending inventory means what is left, right? What is left after the sale has happened, right? So some things got sold, and some of them got sold, and some of them didn't get sold. So whatever is left, whatever remains, unsold, came from, right, the last batch of purchase, right? Last batch, right? So if you use that assumption, then you might think, oh, 4,500 must have come from this, so we will apply this price. Yes, that's fine. That's not wrong, okay? But then that is you. That is, that is you making that judgment, right? then you're getting involved in every step in this, and there's no point in using Excel. There's no point in using a computer. Using the computer is to automate this process, right? So how do you automate this process? In other words, you just provide the logic to the computer and let the computer execute automatically, right? Whether it comes from this 4,000 comes from March or from February, from January, you make the computer execute that, right? So what do you do then? You remember if command. If command comes in very handy. You learn if command, and the application is limitless, right? So first of all, let's think about it this way. Um, so suppose if this ending inventory is less than the March purchase, right? Well, there's no problem. Then all of this ending inventory can be multiplied by March price, right? It will be valued at March price. Otherwise, then otherwise means what? That means this didn't come entirely from this. In other words, if this is not less, if this is not less than this, in other words, if this is greater than this, then it will have to be split. Of course, in this example, this is not greater than this, so nothing needs to be done further. But what if this is like 13,000 units? If it is 13,000 units, it cannot come entirely from March. But then logically, what can happen is, what it can do is, um, if it is 13,000, 12,370 of that came from March, and the balance came from February. So you will multiply 12,370 by March price, and the difference between 13,000 and this will be multiplied by this. So that's what you're going to put in there. If that's not the case, I mean, if otherwise, then you will need to multiply this by, right, March price, and add difference between the two, multiply that by February price, right? Makes sense? Then think about it. It's going to automatically, Excel will notice, Excel will understand. Excel, I've been telling you, is so smart, right? Smarter than you think. So it automatically, it makes a comparison. So it will pick this, and this won't be executed. Only this will be executed, right? So hit enter, you will see. Okay. So that's this times this, this times this, and I'm sorry, this times this. And then Lifo. Lifo is last in, first out. Now, if you think about it, that's not a very natural assumption, right? Because if it was purchased last, I mean, how can March purchase be sold in January, right? That's totally, that's counterintuitive, and it's illogical. But then this is simply, artificial way of doing that. Why? Why would they do that? You know, if the price is, I'm going to get back to that, with the slide, because the slide explains it well. Um, uh, but suppose, I will have to explain it anyway. Um, I will explain it after, finishing these, examples, and than going back to the slide, right? After going back to the slide. So if you use LIFO assumption, right, whatever is left came from January. So we will we will value it at January price. But then the thing is, fortunately, we're lucky, the ending inventory is less than the January purchase, so we can multiply all of it by January price. But what if it is not the case? So then I say the model should be, right? The model should be universal so that it can be applied to any situation, right? Um, so we all know, that this can be multiplied by the January price, but that's the human intervention. We want to minimize the human intervention, right? This decision, humans only need to provide logic to the computer and let the computer execute the logic, okay? So that's why we are then doing, once again, if command, and then if ending inventory is less than the January purchase, right? Quantity of January purchase, then it's simple. You simply multiply, right? And multiply by January price. Otherwise, if that's not the case, the entire January quantity will be, January batch will be multiplied by March price. And the difference between here, this one, ending inventory and the January, that difference will be valued by February price. Okay, close the parenthesis. Okay. So that's the logic, right? So hit enter. What do you get? Yeah, that's the LIFO valuation of ending inventory. Now, here's a quick reasoning, or I mean, if you are smart and clever, this is giving you, this is revealing two things to you. First, between weighted averages, weighted average seems to be in between FIFO and LIFO, right? And FIFO seems to be greater, and LIFO seems to be lower. No, it's not always so. I mean, the weighted average will, if you do the second example, you will see. It's true that weighted average will be in between FIFO and LIFO, but FIFO isn't necessarily greater than LIFO all the time. It can be the other way around, but it is this way only in this example because the price is increasing as time goes on. If the price is increasing, right? Well, look, LIFO is valued at the earlier price, so it is valued by the lowest, right? So what does this mean? If the price is decreasing, then you will have higher LIFO than FIFO, right? And again, we're going to go back to the slide and discuss it further. But for now, let's do the next example. And in our next example, we have we have June, July, August in the slide, but we have June, July. So let me change this to July simply. Let me change this to simply July. Okay, and the quantity in 11,000, I made it 11,000, what was that? 11,328. 11,328. And was July 15,565. 15,565. August 12,673. 12,673. To make it coincide with our slide example, and the price in this example is 45.50.48. Oh, complete 45.50.48. So this is not a tennis ball anymore. It's probably more like, must be like golf shoes, right? I don't know. Uh, uh, Tennis shoes or basketball shoes, golf shoes, whatever. And then, what is the ending inventory in this example? The ending inventory in this example is 13,450. This one also in the slide was slightly different. 4,572. 4,572. Okay. Now, so let's find out. I mean, it's not a difficult thing. I mean, it's just repetitive, right? Because we've done this. All you need to do is multiply this by this, and then drag it down. And then find the sum, right? Using auto sum, right? And then also using auto sum, right? And then our weighted average unit price is this divided by this. Okay. And then and this column is automatically, populated because the formula was already filled in there, as you can see, right? Weighted average cost method, right? You multiply this by this. FIFO, the same logic there, right? Oh, it's a little more complicated here. Why? Look, no, it looks, it's the same thing. I mean, if Q10, if this ending inventory is, I used, a reverse logic of that. If this thing is greater than, it's FIFO, so whatever is left comes out of the later purchase, right? If it is greater than this, then you will need to split it. And then previously, it wasn't ending inventory wasn't greater than the purchased quantity in each month, so it was easily done. Here, the other side of the logic, the other part of the logic will come into play. So if it is greater, then you will have to split it, right? Out of 13,450, 12,673, it came from August, so you multiply it by August price, and the difference between this and this will be picked up by July, right? It will be picked up by July. So that's the difference times July price, okay? Otherwise, if that's not the case, you simply multiply this by, this by this. But of course, Excel will execute this part, right? Because this is the part that applies to in this example, right? So there you go. And in Lifo, right? Again, the same logic, right? If the ending inventory is greater than this, then you'll need to split it, right? This much out of this 13,450 came from June, right? But the difference, in other words, this minus this, must have come from July. So if Q11 is greater than this, then we use this logic, right? This ending inventory, this much of that ending inventory will be multiplied by June price, which is M9, plus the difference between this and this will be, right, multiplied by M10, July price. Otherwise, it's simply this times this. But this part will be ignored because it won't be executed, because that's not the case, right? So this way, right, if command comes in very, very handy. Once you know the if command, the application is limitless, right? And then we don't need to do this right now, but let me see. So let me switch, okay? So from the Excel, let's go back to our, I'll have to stop sharing. I'll have to go to, PowerPoint. Let me share that. And in this, so this is the example we just did, right? These are the examples. Now, so let me explain. Let me explain, what makes the difference between FIFO and LIFO. So think about it. In our previous example, FIFO gave you a smaller ending inventory, right? Our example, right? Oh, in our previous example, what I'm saying is, in this example, LIFO gave you a smaller ending inventory value, and FIFO gave you a greater ending inventory value. But then, what difference does it make? Well, if there is, think about it. as ending inventory goes down, if you have a smaller ending inventory, what does that mean? CGS is greater. If CGS is greater, EBIT will be smaller, and EBT will be smaller, right? And then smaller EBT will lower the taxes, right? So think about it. When prices are increasing, that means there is an inflation. Inflation is positive, right? Of course, just looking at the 3 months, is you can't use that as an example of inflation. But at least you have a 1 year, at least a year's worth of data, right? But then this is a small scale. I mean, if you're just using a very small scale example, over 3 months, at least you've seen a price appreciation. And if that is an inflation across the entire economy, right, due to inflation through ending inventory, using the higher ending inventory would lower the CGS, so it will increase the EBT, it will increase the taxes. So which did that? Smaller ending inventory is Lifo, right? Lifo gave you a smaller ending inventory. So FIFO gives you a tax advantage, right? During the period where you experience inflation. FIFO is your preferred method. And when prices are going down, right? So then if prices are I'm sorry, I just I got it, I mixed. During when prices are going up, smaller ending inventory will give you greater CGS. Greater CGS gives you a smaller EBT. Smaller EBT will give you smaller taxes. So during the period of inflation, during the inflationary period, using LIFO will minimize your taxes, so they will maximize your profit. So LIFO is preferred generally during the inflationary period. But then this doesn't, once again, then problem is that then during the deflationary period, when inflation is negative, then should we use FIFO? Because if you use FIFO, then during the deflationary period, that would lower the using FIFO will lower the ending inventory, and vice versa. Yeah, I mean, theoretically, if you can switch between LIFO and FIFO that easily, then that's fine. But in reality, IRS doesn't allow you to switch between LIFO and FIFO frequently. I mean, you can switch between LIFO and FIFO with the approval of IRS. But this, you cannot do it frequently. I mean, you may change once in like every 10 years or every 20 years, right? You may change once in every 10 years or every 20 years, but you cannot change frequently, like every year. Makes sense? They don't allow it. Okay, so if that is the case, IRS will always be the loser, right? IRS will be always at the losing end, so they don't allow you, right? So that's the reason behind LIFO and FIFO. Okay, so that's the that's it for today, and we're gonna continue with this work. We're gonna pick it up from where we left off. So we're gonna be on next, more complex, more extensive example, more extensive and complex example in our next class. Okay, that's it for today. Thank you for joining. Thank you for watching. End of video.